What do rising bond yields, China's tariff changes, and consumer distress reveal about our economic future?
That's right. Experts like George Gammon, Stephan, and Stephanie Pomboy are here to unravel the complexities.
We've condensed their wealth of knowledge into bite-sized takeaways to save you time and empower your decisions.
Stick around. George starts by redefining what rising yields really mean for us.
And don't miss Graham's take on how tariff movements could reshape our trading landscape.
Plus, Stephanie's insights could change how you view consumer confidence in this market.
Today, we're exploring an analysis by George Gammon on the implications of rising bond yields and how they reflect economic growth.
George argues that the current narrative surrounding bond yields is fundamentally flawed.
George Gammon highlights how rising bond yields are mistakenly interpreted as a lack of demand for treasuries.
According to George, higher yields signify growth potential, not economic failure.
What does George say about the relationship between yields and economic growth?
George explains that higher interest rates are inherently linked to stronger economic growth.
How does George challenge the narrative of supply issues in the treasury market?
George insists that a flat yield curve suggests significant demand for treasuries, countering mainstream arguments. What does George say about the concept of bond vigilantes?
He points out that the narrative of bond vigilantes is misguided, as rising yields correlate with actual growth conditions. What conclusions does George draw about future investment strategies?
He advises monitoring yields and adapting based on actual growth indicators instead of mainstream narratives.
What does George recommend for investors moving forward?
He underscores the importance of aligning investment strategies with genuine economic growth and inflation forecasts.
Today, we're diving into an analysis by Stephan about recent changes in China's tariffs and Trump's trade agreements.
Graham emphasizes the potential repercussions of these developments on global trade conditions.
According to Stephan, the adjustments in China's tariff structures could lead to enhanced economic activity.
Additionally, he points out that these trade agreements could play a vital role in fostering market confidence.
What does Graham imply about potential market effects?
He expects that increased trading activities could positively influence stock performance, especially in sectors aligned with these agreements.
What challenges does Graham outline in relation to the trade agreements?
He points to potential uncertainties regarding the execution of these agreements that may result in market fluctuations.
What growth predictions does Stephan provide?
He highlights that while initial market reactions may be favorable, sustainable growth hinges on the stability of global relations.
Graham encourages investors to actively seek out sectors that could benefit from improved trade environments.
He also underscores the importance of maintaining informed vigilance regarding geopolitical changes that could influence market conditions.
Today, we review insights from Stephanie Pomboy concerning the recent rally driven by a temporary ceasefire in the U.S.-China tariff situation.
Stephanie cautions that this ceasefire might merely distract from deeper issues within our economy.
Stephanie Pomboy argues that while the markets cheer this tariff pause, they overlook critical issues like escalating fiscal deficits.
She believes this temporary relief may mislead investors about long-term implications. Stephanie states that the 10-year Treasury yield is a significant macro signal showing investor expectations about the economy.
Rising yields imply increased borrowing costs, putting pressure on corporate profits.
Stephanie highlights that consumer credit delinquencies are at their highest levels, indicating widespread financial distress.
She notes that declining consumer confidence reveals broader economic challenges. Stephanie emphasizes that a large volume of corporate debt is maturing soon, raising concerns about refinancing in a high-rate environment.
This impending corporate debt issue could affect overall market stability.
What are Stephanie Pomboy's predictions for future market conditions?
She anticipates that without significant structural changes, the market may face a correction as valuations remain excessively high.
In her conclusion, Stephanie warns that neglecting fundamental fiscal issues puts investors at risk.
She emphasizes the necessity of prudent economic policies and vigilance regarding market signals to navigate upcoming challenges.
Welcome back. Today we're diving into key insights from Trade Brigade, led by Matt.
Absolutely. Matt highlights how the CPI report is shaping bullish trends across major indices.
Matt points out that the CPI report has eased previous concerns about inflation.
This positive response has propelled indices like the Nasdaq and S&P 500 higher.
What levels should we be watching for continuity in the indices?
Matt emphasizes the S&P 500's movement past resistance and the Nasdaq's upward momentum.
NVDA seems to be in a strong position with potential breakouts ahead.
Conversely, Tesla needs to overcome resistance to confirm bullish trends.
What does Matt predict for market trends this week?
He anticipates volatility, but remains bullish as long as key levels hold.
Matt advises monitoring stocks like NVIDIA and Tesla for breakout opportunities.
He concludes that remaining alert for economic updates will be crucial in the coming days.
Today, we're looking at a market analysis by the presenter from the Technical Traders, focusing on significant trends in equity indices, commodities, and the implications for investors.
The presenter highlights concerns about dividend stocks and offers insights on potential corrections in the broader market.
The presenter discusses the unpredictability of market trends, suggesting that indices may face imminent corrections.
There's a significant concern regarding dividend stocks, as the presenter points out their poor performance in a volatile market.
The presenter highlights that dividend stocks have dropped significantly, underperforming relative to the S&P 500, raising concerns about their stability.
This analysis challenges the conventional belief that dividend stocks are inherently safer investments.
According to the presenter, there's a bearish sentiment surrounding the S&P 500, indicating potential market corrections ahead.
The discussion urges traders to remain cautious and adaptive amidst these changes.
The presenter reflects on historical trends, indicating that gold may undergo significant corrections akin to past financial crises.
Bitcoin's bullish outlook may shift if the broader stock market declines, highlighting their interconnected movements.
Looking ahead, market corrections may mimic those during significant downturns, potentially impacting investors.
The presenter predicts increased volatility and advises traders on strategic positioning.
In conclusion, the presenter advises traders to develop proactive strategies in anticipation of market volatility.
Maintaining awareness of market conditions will help traders navigate emotional reactions and implement sound investment decisions.
Today, we'll delve into David Rosenberg's analysis of the recent market dynamics and economic conditions as discussed with David Lin.
David's insights stress that the market is responding dramatically to trade updates, which he believes overlook the broader economic context.
Rosenberg asserts that the recent market surge results from oversimplifying the trade situation between the U.S. and China.
He emphasizes the mistake in thinking the trade conflict is resolved.
What does Rosenberg think about the latest inflation data?
He acknowledges it as a positive sign, but cautions that it doesn't alleviate overall market uncertainty.
What are his thoughts on the labor market?
Rosenberg warns about weakening internals in the labor market despite a low unemployment rate.
What are Rosenberg's recommendations for investors at this time?
He suggests strategically reducing risk in portfolios and favoring stable investments.
What does Rosenberg foresee for the economy in the near future?
He suggests a recession is likely, influenced by market conditions and policy decisions.
As the year progresses, what economic scenarios does Rosenberg see unfolding?
Rosenberg warns of significant economic hurdles, including a possible recession.
In concluding, what is Rosenberg's final advice?
He stresses the importance of careful investment planning and readiness for economic instability.
What a compelling discussion we've had today with our esteemed guests.
Indeed. From David Rosenberg's critique of the market's reactions to trade news to George Gammon's fresh perspective on bond yields, it's been enlightening.
I particularly found it intriguing how they all agree on the volatility in the market. But boy, did they have varied views on what those bond yields really signify.
Yes, George really shook things up by suggesting that those rising yields might actually be signs of growth, while many still cling to the failure narrative.
And can we talk about Stephanie Pomboy's cautious take on the U.S.-China trade ceasefire? It's alarming how much she emphasized consumer credit distress.
Absolutely. It highlights how multifaceted these conversations are. While Matt and the Technical Traders advocate for vigilance amidst optimism, they stress not to ignore underlying risks.
Before we wrap up, let's remind our viewers that these insights can really influence their investment strategies.
Right. If you enjoyed hearing all these viewpoints, give us a like, subscribe, and hit that notification bell.
Thanks for joining us. And don't forget to tune in for our next video where we delve deeper into the global economic landscape. It's definitely one you won't want to miss.